Good afternoon, everybody, and welcome to the ENS webinar, the Masterclass on Value-Added Tax, and specifically dealing with Binding General Ruling 16, which was amended from November last year. My name is Charles de Wet, and I'm joined by the VAT specialist at ENS, to talk through some of the detail and the practical implications of what was published. I think that what we have seen over time is that Section 17, which deals with the apportionment principles and specifically requires an apportionment of expenditure when there's a dual or mixed purpose between taxable and exempt supplies. Now, this has been in our lives ever since VAT was introduced in South Africa, but it has become more sophisticated as we've gone along. We are now on issue 3. The previous version was obviously issue 2, and we'll get into some of the detail of the proxies that have now been introduced. I think what is absolutely critical in the circumstances, as it does require a fair and reasonable result. What we have seen over time, and we'll talk to some of this as we go along, is the best way to achieve that fair and reasonable result. I think that often what we as vendors or we as advisors to vendors think is fair and reasonable is not necessarily what SARS thinks is fair and reasonable, and we are seeing more disputes arising in this particular space. I mean, part of the reason that SARS has gone into this level of detail in terms of designing sort of the proxies in terms of getting to an answer is simply because the SARS experience, the rulings unit that these days sits under leveraged products, receives more applications for alternative methods of apportionment than anything else. We've also seen that in terms of the VAT published rulings in the last little while. So far only 8 have been published, all of them relating to apportionment. And if there's time, we'll talk to sort of those alternative methods as well. Just from a process perspective, I mean, you're welcome to raise any questions that you may have in the Q&A box. We'll try and respond to that or talk to you after that if there isn't time to deal with it during that. During the webinar this afternoon. What I would like to do, though, is to introduce the specialist VAT team that forms the panel and that we're talking to the detail this afternoon. I mean, we have Annelie Giles, who's an executive based in Johannesburg. I mean, she spent her whole career in VAT and has really become a specialist in consulting across a wide range of industries. She spent a lot of time in the mining space, and she's my go-to person in respect of specific areas. I mean, the change in use on housing developments. If you have a question, then Annelie's your person. But sort of even outside of disputes, she's also, I mean, represented some clients in court, especially in relation or in the gold space. And the other thing that she's really famous for is the domestic reverse charge on precious metals. I think that she's the leading expert in the country as far as that's concerned and the practical implications associated with that. Also on the panel is Seelan Moonsamy. Now, Seelan is a tax manager also based in Johannesburg. He spent part of his career at National Treasury looking at policy and drafting VAT amendments in the VAT space. It gives him some insight in terms of sort of the origin of some of the provisions and what the objective of them was. I mean, these days his superpower is drafting opinions across just about all industries. And his favorite thing is to take account of recent court decisions, not only local but international court decisions as well. Riette Lombard is a senior associate in Cape Town. She has dabbled in dispute resolution and also tax exemption, but is mainly a deep VAT specialist, also advising across a range of a range of industries. And in this space, in a law firm, somebody that can also do apportionment calculations, which is always important when you're talking about BGR 16. Jo Roman is also a senior associate in Cape Town. I mean, she's a VAT and income tax specialist. I mean, I know that since I've been at ENS, I always thought that I could draft a reasonable opinion. I've discovered that Jo's much better at it than I am, and that it's better just to leave her to do the first draft, or to fix the sentences that I get wrong. She also has significant court experience. She was involved in the most recent travel case that you may be aware of, and is also currently the instructing attorney on another VAT case that we will hopefully end up in the tax court in the foreseeable future. The newest member of the team is Anjé Albertyn, which is an associate based in Cape Town, and also has experience in VAT cases, having been involved in the travel case. And is one of the smart person who discovered that VAT is the most exciting tax, and that she needs to specialize in that as well. If we talk about kind of the program today, I mean, it's literally to get down to the practical implications of version 3 of BGR 16. I think that as we try to implement it, there are some interpretation issues as far as that's concerned. I mean, there was a fair amount of consultation, both with advisors in the space, as well as with people that were affected by it as part of the public hearings that SARS did. And I mean, even this morning, we had an internal debate as to the way that you apply a particular proxy that I have identified in the circumstances. What is significant about it is gone from a 3-page document to an 18-page document. That makes it much more difficult to apply, and in some instances even to remember the principles that apply in those circumstances. What always made it easy for me was that you could look at the sort of the face of an income statement and do a very quick calculation in terms of working out how close to de minimis of 95% you were, and whether you needed to spend time on apportionment. With all the proxies that are now in place, and the adjustments that you need to do, including sort of fictitious supplies, or specifically in the interest space, it's not something that you can do on that basis. So vendors that were previously didn't really have a requirement to do a detailed calculation will be required to do that, just to satisfy themselves that they in fact don't have any apportionment issues as when they start applying BGR 16. But I think let's get into some of the detail and some of the practical implications on it. Anjé, if you could maybe start about talking about, investment and financial products and how they play into apportionment in these circumstances.
So issue 3 of BGR 16 lists a number of exclusions that weren't expressly excluded in the previous version of BGR 16. So the majority of the items that have been listed as exclusions relate to transactions that would typically have been on capital account. So from an accounting perspective, for example, these amounts would have impacted a company's balance sheet and not their income statement. So I'm going to touch on a couple of these exclusions in more detail, just to illustrate how the inclusion of these amounts could actually distort an entity's apportionment formula. Issue 3, as Charles mentioned, lists certain exclusions that are specific to the provision of finance. So firstly, the cash value of goods supplied under an installment credit agreement is excluded. An installment credit agreement is defined in Section 1 of the VAT Act, but for purposes of this discussion, it's an agreement whereby any goods are sold or supplied by a seller to a purchaser under a sale where the goods are sold against the payment of a sum of money, either at a future date or in installments over a future period. Such sum of money includes finance charges, importantly, as stipulated in the agreement. The aggregate of the amounts payable under the installment credit agreement exceeds the cash value of the supply, and then the purchaser doesn't immediately become the owner of these goods, or the seller is entitled to the return of these goods if the purchaser fails to comply with any terms of the agreement. So an example of where this would apply in practice is in the context of entities such as Westbank or Standard Bank, who provide financing to customers for example, the purchase of cars. So in contracting with customers, Westbank for example, is entering into a financing transaction as opposed to a transaction for the sale of cars. So the cars will merely be an in and an out from a VAT perspective, as Westbank's actual business is not the sale of cars. Westbank makes its profits on earning interest and fees. So those would be the finance charges that are specifically stipulated in the agreement of sale. If the cash value of the goods, so for example, the cars, were included in Westbank's apportionment formula, there'd be a high level of taxable supplies in comparison to the exempt interest and fees. So the inclusion of the cash value of these goods in Westbank's apportionment calculation would massively distort its calculation and result in a higher apportionment ratio. For similar reasons, the portion of a rental payment relating to the capital value of goods supplied under a rental agreement, which is entered into as a mechanism of finance, is also excluded. Then the capital value of loans, as well as the value of equities, debentures, or bonds issued as a manner of raising funds, are also excluded in terms of the new BGR. The receipt of a loan or the issue of shares in a particular year could be quite distortive during that year for two reasons. Firstly, the proceeds from these transactions would be exempt. So these amounts will accordingly be included in the denominator of the apportionment calculation and would result in a substantially reduced ratio. And then secondly, this type of transaction isn't at all indicative of the underlying business of an entity, as these kinds of transactions are irregular and not part of their ordinary day-to-day business operations. Therefore, the reduced ratio also wouldn't be as a result of their underlying business operations. Also excluded are manufactured interest and dividends received by the borrower in a securities lending transaction. Where securities are borrowed, the borrower is required to make manufactured payments to the lender to ensure that the lender is placed in the same position had the securities lending transaction never taken place. The new BGR says that should the borrower receive any interest or dividends on the security in the period that the security is held, those interests and dividends don't really belong to the borrower, as contractually they must be paid to the lender. The manufactured payments aren't included as part of the profit and loss on the trading transaction, so any dividends or interest received on these lending arrangements should also be excluded from the apportionment calculation by the borrower. This exclusion is welcome, especially in light of BGR 62, which sets out SARS' view that manufactured dividends and interest are exempt. This is contrary to Practice Note 5 of 1999 and the industry understandings prior to BGR 62, where manufactured payments were regarded as taxable. The lender in this context must include the manufactured interest or dividends received from the borrower in its apportionment formula, but at a rate of prime less JIBAR. Then finally, interest earned from a vendor's current account, so that's the account used for their day-to-day business operations, is excluded. This has been the dispensation granted by SARS in ad hoc rulings prior to the new BGR, and so it seems as if SARS has now automatically permitted this exclusion without a vendor specifically having to apply for it. Jo will discuss interest in a bit more detail later on, though.
Thanks, Anjé. Riette, I mean, there are other aspects that have now been clarified where there was sort of brief reference to it in issue 2, where there's now certainty in issue 3. Do you want to deal with some of those implications, please?
Sure, thank you, Charles, and hi everyone. Some of the further exclusions that's been included in BGR 16 issue 3 is, and that I'll talk to now, is foreign exchange differences, accounting entry, sale of capital assets, and extraordinary income. So previously in issue 2 of BGR 16, we had 1 or 2 single exclusions in the notes to the methodology. These were one-liners and no further details were actually provided. There were also some items that we've seen in practice that's been excluded, even though from the apportionment methodology or calculations by vendors, even though these weren't actually specifically included in issue 2 of BGR 16. If you didn't fall within one of these exclusions, you were required to obtain a ruling from SARS to confirm that you are allowed to exclude those specific items. So in my view, the change to BGR 16 is a welcome change, as it does provide some clarity, and also hopefully in future less rulings will be required. So the first exclusion that I'll talk to, and which is probably an uncontentious matter, but is foreign exchange differences. So while this was not explicitly stated in issue 2, it was generally accepted, and what we've seen in practice was that vendors excluded non-realized gains from the apportionment methodology or calculation, but that they did include, in most instances, the realized gains. So in terms of issue 3, based on the wording, it appears that you can now exclude all Forex exchange differences unless it forms part of a hedging activity. And my colleague Annelie will speak to this a bit later. The reason for this exclusion is because this is merely an accounting entry and there's no actual activity by the vendor to make the profit or the loss. The next probably uncontentious one is accounting entries. And I mean, as we all know, accounting entries are adjustments to our income in our financials to ensure compliance with regulatory frameworks. So there's no actual income, it's a mere re-evaluation of an asset or a liability in a specific point in time. So since there's no consideration for any supply, it should certainly be excluded from your apportionment methodology. And typical examples would be your foreign exchange differences, as I referred to earlier, or fair value adjustments. The next exclusion is the supply of capital assets. So interestingly, in issue 2 of BGR 16, it provided in the notes that the value of capital goods or services that's supplied can be excluded from your apportionment methodology or your calculation. Although, even though no further guidance was provided as to what would fall within the definition of capital goods or services. In terms of issue 3, we've now been provided with some guidance, and the guide now specifically the ruling now specifically excludes the supply of capital assets. Now, the reason why we exclude capital assets is because the value of these sales are usually high, and it's got no corresponding effort by the vendor to produce the income. So including the value of the sale of the capital asset would distort your apportionment ratio. As you all know, that for VAT purposes, we don't really have a definition of capital asset. And therefore, BGR 16 does try and provide some guidance, and it implies a subjective test. So you look at what the taxpayer's intention was when acquiring the asset, as well as the subsequent treatment or use thereof. Typically, trading stock would not be a capital asset. There's also some factors that's been provided in BGR 16 as how long has the asset been held, and whether this asset stays intact, or whether it's used to produce wealth, or whether it's actually been acquired to sell. Typically, assets that's used to generate income or enable you to do your trade would be capital assets, whereas if it's merely acquired for on sale, it wouldn't be a capital asset. SARS also refers to the capital gains tax guide in BGR 16, which can be used, which is useful to determine whether an asset actually constitutes a capital asset. And then the last one that I'll speak to today is extraordinary income. And it's specifically defined in BGR 16 as non-recurring income received due to exceptional circumstances that are unlikely to be repeated. Now, how narrow SARS will interpret this definition remains to be seen. The reason why extraordinary income should be is excluded from the apportionment calculation is because including it will have a significant impact on your income without affecting your normal year-on-year expenses. So it would significantly distort your ratio and fluctuate from year to year, resulting in a change in use adjustment in 1 year due to the reduction in your ratio, and just reversing that adjustment in the next year. Apologies. So previously also, when we had extraordinary income, we would have to apply for a ruling from SARS. So definitely a welcome change that if your income falls within the definition of extraordinary income, it can now be excluded without having to first approach SARS for a ruling. Typical income that falls within this category is dividend income that's received as part of a restructure. That's it from me for today. If you have any questions, you are welcome to reach out. Thank you.
Thank you, Riette. Now, one of the things that has been very contentious from an apportionment perspective is around the treatment of interest and the effort that goes into treating the interest in an apportionment calculation. So there is now a plan on the table, but it gets complicated. Jo, do you want to expand on that and the way that it's applied, please?
Yeah, sure. Thanks, Charles. Hi, everyone. I think maybe before we go into the more technical detail, I thought it was worthwhile to mention that before the publication of this new BGR, there were very limited comments, particularly in the form of any formal documents or especially in the form of guidance from SARS that existed and articulated the idea of that's now set out in the BGR, which is a net interest method. So at the very least to me, what the BGR does, this new BGR does, is it started the conversation around interest inclusion methods in an apportionment formula, and potentially in industries other than strictly banking and finance, where historically we've seen some arrangements being made to limit the distortive impact of interest in a business. Starting with the detail, and sorry if this is a bit basic, but I think it's worthwhile background. So typically a net interest inclusion, or sorry, starting with the net interest inclusion, what it is the net inclusion of interest in the denominator of your apportionment formula. So essentially taking your gross interest amount as an income and netting that off against your expense in order to have a net number included in your denominator. And the reason you'd want this is because a gross inclusion of interest in the denominator of your formula is distortive, given that the number that it spits out, your apportionment recovery rate would be lower given the larger gross inclusion of interest in your denominator. So what I think one of the things that I hope will come out of our discussion today is that in order for a turnover method of apportionment as set out in this new BGR to work, there's certain underlying assumptions or premises that underpin the apportionment method. And one of these fundamental premises is that there needs to be a correlation, as Riette mentioned, between the income that you've earned and the effort that you've expended to earn that income. So in a sense, what a net inclusion of interest in your apportionment formula does is that it achieves a truer apportionment calculation in the sense that it refines the income that's relevant for purposes of that exact principle for determining the correlation between the income that you've earned and the effort that you've expended to earn that income. So as I've mentioned, in order to calculate your net interest that you include, and this is set out in the BGR, you need to start off with your gross interest income and net that off against your gross interest expense. However, what the BGR says is that you don't need an actual interest income or an actual interest expense in order to qualify for this net interest method. And if you don't have either the interest income component or the interest expense component, you can use what the BGR refers to as proxies 1 and proxy 2. So proxy 1 applies where, being the outgoing leg of your business, if you've made a supply of a loan or an advancement to any person and you haven't charged a consideration for supplying that loan, so you haven't charged interest on that loan, proxy 1 says that you must recognize a notional interest income stream in respect of that advancement. And the way you calculate that notional income stream is by multiplying the amount that you've advanced by the prime interest rate. On the other hand, proxy 2 applies if you don't have the expense leg of the net interest calculation. And proxy 2 says that if the funding you've acquired in your business doesn't bear an interest expense, that's not an issue because you will recognize a notional interest expense and you calculate that by multiplying your funding, the loan that you acquired in your business, by JIBAR. A question that arose to me while I was preparing for this is whether there's potentially a planning opportunity if you've acquired favorable funding rates and it leads to a lower interest inclusion than would have arisen if you'd applied the proxy. I wonder if you could apply to SARS to, in lieu of your actual interest rate, apply for proxy 2 to apply to your funding leg in order to achieve a better net interest inclusion in your denominator. my view on notional interest as a concept, as referred to in these proxies, and I think it's become more relevant now, given that it's quite a defining feature of the net interest method. My view's been that creating fictitious supplies, and particularly exempt fictitious supplies, overrides not only the policy intent which is set out in the legislation, but the express definitions in Section 2 of the VAT Act, which say that only interest-bearing funding is definitionally relevant for purposes of any exempt activity that's recognized in not only the VAT Act, but also going further than that, BGR 16, i.e. relevant for purposes of your apportionment calculation. So zooming out slightly, I think there could be a level of uncomfortability in having these proxies, which, for want of a better word, codify the concept of fictitious supplies. And the reason I use the word codify is that, as the McCurry judgment has confirmed, BGR 16 is binding on all taxpayers. And to me, a question then arises is whether the BGR, and in particular these proxies creating these deemed exempt supplies, could be open to challenge not only on a technical basis because of the reasons I've just mentioned, but also potentially from a procedural perspective, if it could be argued that SARS has stepped slightly closer to lawmaking or legislating than should be allowed. That's potentially a discussion for a different forum. One of the positives, though, that I think comes out of these proxies is that it seems that SARS has granted some leniency in strictly applying what they refer to in other places in the BGR as a prerequisite for applying this net interest method. And one of these prerequisites is that funds must be borrowed by the vendor in order to be on lent to qualify for the net interest method. And read into this requirement, there must be an interest expense that has been incurred that is then matched to your interest income. As I've just explained, Proxy 2 effectively overrides this principle and says that even if you have no actual interest expense, you could still qualify for this net interest inclusion in your apportionment formula, because Proxy 2 allows you to recognize a notional interest expense. So given this perceived leniency, is what I will call it, we were a bit surprised by the outcome of multiple submissions that we made. And the outcome of those submissions is recorded in the notes to the BGR, which expressly state that this net interest inclusion or this net interest method is not applicable in the context of retailers. And what the BGR defines as a retailer is any vendor who makes a taxable supply of goods or services, but also supplies goods or services on credit. So attached to, for example, a single sale to a customer, you've got not only your taxable goods or services that you supplied for a consideration, but you also will be earning an exempt interest income from that activity because of the credit component of the sale. And SARS's reasoning for excluding retailers from this dispensation, and we've heard this not only in our discussions with them, but it's also set out in the BGR, is that because SARS recognizes or permits a gross recognition of the value of your taxable supply coming from that single sale, it would be inequitable in their view to also then permit a limitation of the amount of interest that's included in your apportionment formula. So we don't necessarily align ourselves with that view. And on the contrary, we've done quite a bit of work in comparing the logic in the BGR and the principles that I think can be still distilled from that logic, and applying that to retailers. And for the exact reasons or thereabouts set out in the BGR, it seems to us that retailers in principle should be permitted to apply this net interest method, especially where you have an actual interest expense and you don't need to rely on Proxy 2 for a fictitious interest expense that exists in your business. It also seems to us that for additional reasons, for example, the fact that interest in a retail space can be sizably impacted by external factors, that it would be fair and reasonable. Again, one of the requirements for this turnover method, it would be fair and reasonable to cap the amount of interest recognized in the hands of retailers, given that these external factors influence and therefore demonstrate an inherent variability in the interest component of or the interest income in the hands of retailers. And so what it would then demonstrate is that the interest income itself is distortive to the fundamental principle which I mentioned, which is that there needs to be a correlation between the income that you've earned and the effort that you've expended to earn that income. The final 3 points that I'd like to make, and I'll do that briefly just in the interest of time, is that firstly, where we've spoken now about where it doesn't apply, which is in the retail space, but where the net interest method does apply is in the context of intergroup financing. So this is important not only because a net interest inclusion has an obvious upside for a treasury type company who now would potentially, as a result of this net interest method, have an increased recovery rate, but also because there's now a potential additional exercise which needs to be done, given that, to me, conventional wisdom has been that you avoid the complexity of mixed business or a business with mixed income streams if the loans that you've advanced within a group are interest-free. But given what we've just mentioned now about the proxies, and especially proxy 2, which says, or sorry, proxy 1, which says that you have a fictitious supply of exempt supply with a corresponding fictitious exempt interest income where you've advanced loans on an interest-free basis, it seems to me that there's probably an exercise that needs to be done to reevaluate all these kinds of arrangements to check whether there is a potential or an inadvertent VAT cost which now exists that didn't exist in the prior iteration of BGR 16. The next point is that the net interest calculation, while it seems like a fairly simplistic concept, given that it's the net of your gross interest income against your gross interest expense, but there is complexity that arises in practically applying that simple concept to your business. And that complexity is informed by a number of factors, including that you could have multiple loans that you've advanced in any given period. Those multiple loans can have varying terms, including different interest rates and varying balances throughout the period that you're evaluating. And so one of the questions that arises is whether you can aggregate your loan balances, your interest rates in order to simplify the calculation. And that's not answered in the BGR, so that remains a point of debate in my mind. And the final point I'd like to make is that this net interest inclusion of exempt interest in the denominator of the apportionment formula is certainly a positive step for many vendors. But it seems to us, based on our reading of the BGR, the same net interest inclusion also applies where your interest is regarded as taxable. And although generally interest is regarded as exempt, and that's usually the case, there is an exception in that interest from cross-border funding, so where you as a vendor have advanced any sort of loan to a connected or unconnected person cross-border, the interest that you receive on that loan is regarded as taxable because of a carve-out in Section 12A of the VAT Act. So unfortunately, what that then means is that the numerator of your calculation is now also going to be impacted and reduced somewhat by the net inclusion of interest that is also taxable. And then to close up, I would just like to say that I think that BGR has made some massive strides in not only starting the conversation on some concepts that have previously not been articulated, such as a net interest method, but to me it's also in a sense set out the parameters of the logic which SARS applies or had applied in coming to the ruling, and gives us an opportunity to sensibly test those parameters because they've given us so much more to talk about.
Thanks, Jo. I mean, there's a lot of complexity there, and trying to work your way through that often takes it a lot of time. Annelie, you've had some practical experience in trying to apply this on different loans with different rates with different periods. Do you maybe want to comment on how that worked and whether we got to the right answer or fair and reasonable answer in the circumstances?
Yeah, thank you, Charles. So I just actually, from a timing perspective, just want to make a few brief comments on the on interest-free loans. So I do understand the need to include an amount into the apportionment calculation because you want to give effect to that lending activity, but it does become quite contentious in the interest-free loan space. And the first one, there's a number of key aspects, and the first one is that the interest calculation is linked to your loan balance. So the higher the loan balance is, the higher that amount is that you need to include in your apportionment calculation, and that could negatively impact the amount of input tax that you can claim on your mixed purpose expenses. There's also the ruling is silent on whether you need to apportion that interest calculation for a portion of the year. So for example, if the loan was only granted throughout a portion of the year, and whether you then need to apply, for example, for that part of the year, or whether it is for the full amount of the year. The other thing to remember there is that there is no actual interest income. And as Joe explained, that is not a supply that is recognized from a VAT perspective in terms of Section 21F of the VAT Act. But yet you need to include an amount in your apportionment calculation. So it's a little bit delinked from the normal principles that can then obviously negatively impact your percentage. And then the last one is also, it's not limited just to a borrow to on lend scenario. It's also where you provide funding from your own cash resources, where you would need to have a deemed inclusion into your apportionment calculation, both on the income side as well as a deemed expense. So even though it's on a net basis, there is still an amount you need to recognize, which is not visible otherwise from a VAT perspective. So yeah, that's just a few comments I wanted to make. Sorry, just from a practical perspective, the scenario that we dealt with is that there was a number of interest-free loans, and that actually amounted to an inclusion of about 100 million rand into the calculation, which then dropped that ratio by up to, I think it's 2 to 3% on, depending on the different years. And even though that drop in percentage is not that significant, when you apply that to a big pot of mixed purpose expenses, the impact is quite significant. So it is a contentious issue that is in the ruling. But I think we have moved quite far along in that at least the inclusion is on a net basis. Thank you, Charles.
Thanks, Annelie. So, I mean, but besides the complexity, there is in fact it could be quite a significant impact as far as that's concerned, and not something that you can just accept that you stay above de minimis. So it's something that requires attention and sort of careful working through to get to whatever the answer might be in the circumstances. While you're talking, Annelie, don't you want to pick up on some of the other aspects around Forex and trading in financial assets and how they now get included in these circumstances?
Yeah, sure. So Riette did explain, the non-contentious side of the foreign exchange differences that you need to ignore for apportionment purposes. And that is where you have a transaction that is converted from one currency to another. Those differences are from an accounting perspective, so you don't take those into account. But when it comes to hedging activities or trading in financial assets, those differences definitely need to be taken into account at a proxy. And the proxy is a 3-year moving average of the gross trading margin. And that then, in essence, focused on the realized gains from those transactions. And you work it out, the average is the current year plus the prior 2 financial years. Then on this, it's very important to do your splitting of all your foreign exchange differences. So first of all, you want to isolate the normal foreign exchange differences and ignore that. The other side, you want to determine what is profits, what are losses, ignore the losses. And then out of the profits, you just want to get to the realized gains, so the realized profits on those transactions. And we had an instance where SARS simply took the amount on the financial statements as disclosed as foreign exchange profits there, and they sought to include the entire amount, which was 275 million, into 1 year's apportionment calculation. When the vendor actually did the splitting out of that, those gains, the true inclusion, which SARS then subsequently accepted, was only 5 million. So the detail does matter, and it is also important to actually put in the work to try and split it out as much as possible. Where SARS is saying if you cannot, so the ruling says if you cannot split it out, you do look at all your realized and unrealized profits and losses, but the amount could be vastly different from the true amount if you're not careful. So the work needs to be put in there. And then Charles, I'll then continue also on the dividend side. So the dividends is actually, let me just get there, Rob, is actually a bit of good news in the ruling because, and I think the phrase of the year is primeless JIBAR. So in essence, you do include dividends now at a proxy. So it's not your full amount of your dividends. You only look at dividends from investment activities. So for example, you know, in a holding company kind of setup where they receive dividends from subsidiaries, and you look at your 3-year moving average of those dividends calculated at the difference of primeless JIBAR. Now, the ruling does contain quite a number of nuances. And the more I spend time on this, the more complicated it seems to get. So the one thing also is that, and I think Joe briefly referred to it as well, is that dividends from an income tax perspective, so sections 8 cap E and 8EA, those need to be regarded as interest for your apportionment calculation, and you include those at the proxies that apply to interest. Those are typically, for example, preference shares from hybrid equity instruments, or where you have shares that are third-party backed shares, and those have substantial debt features. That's why you look at them from an interest perspective. On the normal dividend side, it does have, like I said, a few proxies, but I'm just going to highlight 2. The one is that when you work out your 3-year average, you look at your current year and your prior 2 financial years. But if you don't have dividends in your current financial year, you actually still need to include an average in that. So you still calculate your proxy for that year and include it in the apportionment calculation. And then also holding companies. It's a kind of a tricky one, because if you do not receive dividends for 2 out of the 5 years, then you still need to include something. But if you are a holding company who charges management fees, then your dividend amount needs to be equal to your management fees. And the way we read the ruling is that dividend equal to management fees, you times with by primeless JIBAR. So in essence, even if you don't regularly receive dividends, you need to include something. But what the ruling has said, and where there's kind of a big step forward, is on 2 fronts. So on the one side, they sought to recognize that dividends are distortive. So that's why we're looking at primeless JIBAR, which currently is only about 3.5%. So it's not 100% of dividends. And then the other side is where it is not a regular feature that you receive, you still include something, and that is where the 3-year moving average comes into play. So there is quite a bit of thought put into that proxy that you need to include, and I think we have come a long way on that as well. Charles, would you like me to move on to the debt securitization?
Yes, please, shortly, if you could, Annelie.
All right. So there we also need to include a proxy. So in essence, it is the proceeds on the sale of the debt value, and also again at primeless JIBAR. The important aspect here is that if there is a loan that is originated and shortly after the origination, before that vendor receives any VAT exempt interest income on that, for example, on that debt book or that loan, and it cedes it away or sells it, there's still a deemed proxy that you need to include as the seller, and that is equal to the origination fee, even though that vendor itself didn't receive any exempt income at all. Thank you, Charles.
Thanks, Annelie. Just gives you a sense of sort of the complexity and the aspects that you need to take into account in terms of getting to a rate. And you can see lots of disputes with SARS on a go-forward basis in terms of whether you've included the right amount or not. I mean, another new inclusion is also about bad debts and the way that should be taken into account. Seelan, do you want to talk to some detail as the practical implications of that, please?
For sure. Thanks, Charles. Hi, everyone. I think for good measure, Charles, and since Annelie has said that primeless JIBAR is the word of the day, I think we should make T-shirts for our clients. Primeless JIBAR, because I've been dreaming about primeless JIBAR. That's putting it mildly. I just want to discuss 2 aspects with you very quickly. The first one being the bad debts adjustment. Owing to the fact that a component of the interest rate charged by a lender to a customer includes an element of credit risk, the actual amount of bad debts written off by the lender during the year may be used to reduce income already included in the apportionment formula. Now, that income may have been included in the current year or in previous years. Bearing in mind that a lender earns both interest and fees on a loan, SARS has provided some relief for bad debts written off. So what the vendor needs to do is to use the actual amount of bad debts written off. And then what you do thereafter is determine the portion that relates to the interest. And this amount is applied towards reducing the net interest income. Bearing in mind that net interest can consist of both exempt and zero-rated interest. If you're lending to a foreign borrower and you derive interest therefrom, the interest is zero-rated. After that, you would determine the portion of the bad debts written off that relates to fee income. You'd apply this quantum towards reducing your fee income that you've included in the formula. I think many of you would have seen the Constitutional Court judgment in Capitec that came out recently, where they've done a split between the interest and the fee income. And I think in that case, which was a favorable judgment for Capitec, the court looked at a ratio, an apportionment ratio, where it used the fee income as a percentage of the total consideration. And in doing that, afforded Capitec some relief on their pleadings. What we need to bear in mind is that the capital portion of the bad debts written off is not taken into account whatsoever. So you disregard that simply because the capital value of those loans was excluded from both A and B in the formula. And lastly, on the topic of bad debts, where you've recovered bad debts, the vendor must include the portion of bad debts that relates to the interest and fees components accordingly. In essence, what the vendor is required to do is to do the opposite of what was done initially, relating to the reduction of net interest and the reduction of fee income. Effectively, this is, you add back these amounts. One other thing I want to touch on very briefly is profit share from joint ventures or partnerships. BGR 16 says you need to take these things into account, and this has got some sort of nexus to what Annelie has discussed a short while ago. So I don't want to repeat any of that, but just to shed some light, JVs and partnerships are common in the mining industry in particular, but they can occur in many industries. Often you have entities entering into a joint venture or partnership to share risk and the financial outlay that is required. Section 51 of the VAT Act 51(1) deems the JV or the partnership to carry on an enterprise separate from that of its partners. You get the distribution of profits from a JV or partnership to the partners that falls outside the scope of that. SARS views the entering into a JV or a partnership agreement as being similar to that where a company invests in another entity and derives dividends therefrom. Hence, what SARS have indicated is that the profits distributed to partners must be included in the formula using the same logic as dividends. It's exactly the way Annelie has explained it. So what you do is you'd use a 3-year moving average of the profit share received or accrued during the year, and you'll multiply that by your favorite word again, prime less JIBAR. Now, interestingly, they've used the word received or accrued. So in instances where you haven't received, you must now determine if that profit is actually accrued, and you'd have to go and apply income tax principles in that regard. One thing to note is that the setup of the JV or the partnership is very important. For example, where a partner makes an undivided right of use of an asset available to the JV or the partnership in return for the distribution as consideration, the treatment is different. There you have a situation where the supply of the right is now taxable, and you should appropriately reflect it in the formula, including it in full. So when you come to JVs and profit shares, you need to be mindful of that. Just quickly running through an example that we have assisted a client a short while ago. That's in line with what SARS have said in the BGR. We assisted a holding company that's listed on the JSE, which derives management fees, interest, and dividends. Sometime in 2018, 2019, the holding company flattened its shareholding structure. It cleaned up all its intercompany loans that it had built up over a number of years. What remained was a loan to a subsidiary. The loan was repayable, but it was interest-free. And the subsidiary was a 50% partner in an unincorporated JV. A decision was taken by the subsidiary to use the earnings generated from the JV to pay down its loan. And by September 2021, a few years thereafter, some 174 million was paid down. And during this time, no dividends were declared by the subsidiary to the holding company, but dividends would resume as soon as the capital value of the loan had been fully paid. So we approached SARS for a ruling, i.e. very turnover-based method of apportionment. And lo and behold, SARS applied prime less JIBAR, that margin, to the outstanding capital value of the loan, and included this notional amount in the apportionment calculation of the holdco as interest. And SARS also said that in instances where holdco does not derive dividends, you'd have to include a proxy based on management fees, which Annelie has explained, so I won't repeat that. At the subsidiary level, we understand that SARS treated the profit share as dividends by using a 3-year moving average multiplied by prime less JIBAR. I think that's all I want to discuss, but I just want to say, as with the effluxion of time, and as more vendors apply this ruling, we can better understand the ramifications of the ruling. And make no mistake, there'll be more disputes with SARS, as Charles has alluded to.
Thanks, Seelan. That sort of talks to the details that are included in the 18 pages of issue 3. I mean, there are some general points that are relevant as well. I mean, as in the past, the principle has not changed in terms of when you do the true-up calculation. So it does make provision for the fact that 9 months after year end, you should do a true-up. And this is when you've used a provisional calculation for the prior year in terms of claiming your input tax. What is significant about that is that, that it's moved to a 9-month period, but in reality, it's not really 9 months. In the sense that if you have a December year end, it's not the September return that you need to include it in that goes in that is then submitted at the end of October, but is in fact your August return that goes in at the end of September. I think there's always been a little bit of debate around that. That is now clarified in that. They also talk, the wording refers to the latest tax period, so you could do it prior to that in the circumstances as well. But in circumstances where you only do it in fact, the September, the 9th month VAT return, there is the potential of late payment penalties and interest, simply because the time of supply in inverted commas would be prior to that. Our view also is that on refunds that, while SARS wants it to happen in that period, there's probably no risk in terms of doing it after that period. Although, it will remain to be seen, the adjustment that was made in the judgment in terms of the claiming of input tax, and whether that gets linked to a particular tax period or whether you can do a catch-up later. I think these are things that will be clarified as those draft amendments are made available for comment. The other aspect that I would just want to mention is sort of when this came into effect. So it talks to year-end starting on or after the 1st of January 2024. I mean, that means that if you have a March or June year-end, you're still in the 2023 a period. We have had a lot of engagement with SARS in terms of trying to apply these principles retrospectively. The argument simply being that if SARS has now changed its view on issue 2, then there's no reason why that methodology cannot be applied to the prior financial year, especially in circumstances where you didn't have a ruling available. SARS is adamant that they're applying it on the same basis as an amendment, so it has an effective date in the circumstances, and they simply will not apply that retrospectively. There is a little bit of a mix as far as that's concerned, because there were some principles, inclusion of dividends on a prime minus JIBAR rate for certain vendors prior to that date. So that one you can probably push through, but some of the others, it's just simply impossible to move them as far as that's concerned. I mean, as I indicated up front, I mean, the intention is that there will be far fewer applications for alternative methods of apportionment. As I said, there are already 8 rulings that have been published. You'll know that sort of from about April last year, SARS did ask on the same as the advanced tax rulings regime that there would be a short version of the VAT rulings that are issued. I mean, there's sort of a range of them. They're all related to apportionment, sort of varying from short-term insurance to holding companies to investment companies to asset managers. If you look at the methods that SARS has applied, I mean, most of them are very turnover. I think that from a terminology perspective, BGR 16 issue 3 now becomes the standard turnover method, whereas or STB, but in fact is an adjustment. So as I say, it's not exactly on the income statement. I mean, just on the face of the income statement, because it's more complicated than that, as we've illustrated. And then there are, I mean, the transaction method has been approved in a number of instances as well. We've sort of come up to the hour. Thank you very much for joining us this afternoon. We think that this is an important development. It has stabilized, although, as Seelan has indicated, maybe there will be more thinking around this after the Capitec judgment 10 days or so ago. If there are any practical issues or questions that you have about this, you're welcome to contact any member of the team, and I would recommend that you move apportionment up your radar screen a little bit, just to make sure as to what the cost is, and the extent that you may need to do a true up after year end. So thank you for joining us, and have a good afternoon.